A lot of folks out there are trying to make the decision of waiting until age 65 to retire, or perhaps retiring a little bit early, maybe even as early as age 62. And if you're in that boat, there's a lot of things that you need to consider. Number one, your Social Security benefit is going to go up or down based on when you file for benefits. You need to think about your health coverage, your health care, particularly if you retire before age 65 when Medicare kicks in. And there are a bunch of other things that you need to look at too. In this video, we're going to cover the top 3 considerations you need to make if you're thinking about retiring anytime before the age of 65. The first thing that might be at the very top of your mind is Social Security. The earlier you file for Social Security benefits, the lower those benefits are going to be. The way your Social Security benefits work is you pay into the system through your payroll or self-employment taxes during your career. And then when it's time to file for benefits, the Social Security Administration adjusts all that earnings history for inflation. They take the average of the highest 35 years of work history that you have, and then they run this calculation. That calculation determines your primary insurance amount. And your primary insurance amount is what you'll be entitled to if you file for your Social Security benefits at your full retirement age. So full retirement ages for people considering retirement these days are probably going to be age 67. If you were born after January 1st of 1960, your full retirement age will be 67. So what that means is if your primary insurance amount is $3,000 per month based on your earnings history, and you file for your benefits at age 67, you were born after January 1st of 1960, you file at age 67, you'll get $3,000 per month, plus a little bit for cost of living adjustments. That amount will go up a little bit every year. Now, if you file before age 67, that benefit will be reduced by 0.5% for each month before your full retirement age that you file. So if your full retirement age is 67 and you file at age 65, that means that your benefits will be reduced by 13.1% permanently. And instead of collecting $3,000 per month at age 67, you'll collect about $2,600 at age 65. So by filing before your full retirement age, it reduces your benefits. Now, if you're filing as early as age 62, the benefits will go down by more. And the first 36 months before you file for your benefits, before full retirement age, they reduce it by 0.5%. Any month in excess of those first 36, they only reduce it by 0.5%. And the way the math works, if you file as soon as you're eligible on your 62nd birthday, you file right at age 62 when you might want to think about retiring, that means that your benefits will be exactly 70% of your full retirement age. So instead of collecting $3,000 per month at 67, you'd be collecting $2,100 a month starting at age 62. Now, that might be the right move for you if you don't expect to live that long. Collect as many checks as you possibly can, file as early as you can, even though they might be smaller. But for people who expect to live a longer and healthy lifestyle, if you think you're going to live into your late 80s, you might think about postponing the filing of your benefits until age 67 or even later. So if you're thinking about retiring at age 62 instead of 65, and you're going to file for your Social Security benefits on that date, this is a consideration. Now, one thing that a lot of people don't realize is that you can retire at age 62 without filing for Social Security. You can pay your expenses out of other assets or from other ways and still wait until closer to your full retirement age to file for benefits and allow that benefit to increase. Those two things don't necessarily need to line up. But the point is that the earlier you file for the benefits, the lower the amount of those benefits. The second consideration that you need to take a look at is where you'll obtain health care from. What will your health benefits look like? If you're retiring at age 65, you're probably going to be eligible for Medicare. If you retire before age 65, you won't be. 65 is the enrollment age. So if you're in a situation where you have a spouse or someone else in your family that's going to provide medical benefits for you, they're going to continue working, maybe they have workplace coverage or something along those lines, that makes this transition before the age of 65, transition into retirement, a heck of a lot easier. because if you don't, you'll have to pick up health benefits on your own, either through your state's exchange, the marketplace, or through a private insurer. The average monthly premium for people who are healthy non-smokers in their early to mid 60s these days is around $1,100 for a middle of the road plan. Medicare consists of a lot of different parts, and it's going to be substantially less expensive than that. Now, when you enroll in Medicare, as you know, there are different parts. Part A is what covers your emergency services. Most people who enroll in Medicare do not have to pay out of pocket for those services because they paid into the system for long enough to qualify during their working years. If you're one of the few people that does not qualify for free Part A, it can be expensive. You're looking at up to about $500 a month. Part B is what covers your primary services, your relationship with your primary care physician, and so forth. In 2025, this year, the premiums are $185 per month or more. And I'll circle back to that in just a minute. Part D is what covers your prescription drugs. The cost of Part D depends on what your insurer sets up and what they're charging you, but the average these days is around $37 or $38 a month or more, which again, I'll circle back to. Most people buffer their Medicare coverage with some kind of supplemental policy. There are about a dozen supplemental policies that you can obtain through an insurer. Another option is Medicare Advantage, but the coverage there is really pretty sparse. Most people are going to be better off paying out of pocket for a supplemental policy, and there are a variety of types of policies. These days, the premiums range from anywhere around maybe $100 a month to up to $350 or $450 a month for the supplemental. So if you get a middle of the road supplemental policy when you're 65 plus parts B and D, you're looking at maybe around $450 a month compared to $1,100 a month, give or take, before you're 65 and eligible for Medicare. Now, I mentioned that parts B and D might be higher than the premiums that Medicare assesses most people. The premiums that you pay for parts B and D depend on your income. If your income is below a certain threshold, you'll pay $185 a month this year for Part B and maybe around $36, $37, $38 a month for Part D. If your income is above a certain threshold, you'll have the luxury of paying Medicare premium surcharges, and you'll be paying more than those amounts. There are several different tiers, different brackets, which we'll show here in our video, and just be aware of that as you go to enroll in Medicare. The third thing that we really need to look at is the span, the timeline of your retirement. To state the obvious, if you're thinking that you're going to live until age 85 and you retire at 65, you're looking at a 20-year retirement timeline. If you retire at 62 instead, you're looking at a 23-year retirement timeline, which means you're going to need to rely on your savings, your nest egg, for a longer period of time. That's the obvious part. What people often forget about is that the earlier you retire, not only are you saving for a bigger, longer retirement, but you also have fewer years to save for it. 3 fewer years in our circumstance. So what we need to consider here is, yes, retiring earlier means we need to have more confidence in our retirement plan because the period of time we'll rely on our assets is longer. But if you're 62, let's use this example. Let's say you're 62, you have $1 million saved in your 401k, and that 401k earns 7% per year. Well, you could retire at 62. Maybe you're filing for Social Security then, maybe you're not, maybe you're waiting. You're probably taking a little bit of money out of the 401k to pay your living expenses. And you want to have a lot of confidence that that $1 million will be enough to last you the rest of your life, which is pretty scary. We don't know how long we're going to live. We don't know we're necessarily going to make it to 85 or that we won't make it to 95 or 100. We don't know what our long-term care or medical expenses might be or what our family situation or needs might be. There are a lot of unknowns. So in this situation, if your 401k earns 7% per year and you just waited until age 65 instead, and while you worked those 3 extra years, you put $1,250 a month into your 401k for a total of $15,000 per year. Just by waiting 3 years, when you retire at 65, you'll have a little bit less than 1.3 million between the growth of the account and your contributions along the way. Now, over a 3-year time horizon, if you're 61 and you're 61 right now, and you're trying to make this decision of retiring next year or at 65, we don't have any idea what the market is going to do over this short time period. But the point is that you allow your nest egg to grow and kind of churn and compound over a longer period of time, and you give yourself a longer period, more years, more months to contribute to it. And those two things really tend to go a long way. That's it for today's video. Hope you found it helpful. Clearly, when we think about retirement planning in general and the decision of retiring between 62 and 65, there are a lot more than 3 considerations. After having done this for a while, I think that these are probably the top 3 that you need to look at, circumstances depending, but this is different for everybody. So make sure that you let us know what we missed in the comments below, and I will look forward to seeing you all again soon.